Now, backed by popular demand, the Investment 360 monthly investor wrap is designed to bring you up to speed on the performance of a wide range of asset classes. So after a great year in 2012, how have your investments been performing so far? Still in studio, renowned financial advisor Warren Ingram and our very own Warren Dick to take us through the numbers. Let's first start off with what are we starting off with? The unit trusts.
The performance of the indices, just to give us a good intro into how the markets are performing, because these are the indices we talk about all day on TV and write about, Warren. I just wanted to bring your attention to a few things here. First one was the performance. Here's the FTSE JSE Top 40, 22.7% for the first year, which I think all investors are very happy with. But if we look at the 5-year performance, 8.15%, that is about half the long run average of the JSE.
Yeah.
So have you when you see these returns being depressed, do you automatically ask clients to start contributing more to retirement savings? Because you never know how long this can go for. We could have depressed returns for a decade, like the S&P has been in the States. Mm-hmm. How do you guide your investors through that?
So I think what's interesting is, that includes the 2008. That's the big problem there. And what we were finding at the time, because it always depends on the cycle. So at the time, it was then a case of trying to get investors to put a bit more into shares, as opposed to saving a bigger percentage. It was more about saying, just get your mix of your assets right. Because, you need to, the answer to saving is, save as much as you possibly can, right up to about 20% of your total income every year. So that's a big amount, and most people never get there.
That's a big ask.
That is a big ask, and trying to convince them to do that is extremely difficult. But if you really want to be absolutely sure of retiring safely, that's the amount you do need to do it. So what happens is, it's more about just getting the mix of the assets right, and always pushing them to save as much as they can. And for example, now it's a case of trying to manage their expectations, because the stock market did, I think it was 27% in 2012 or 24, 25%. Now it's slightly less, but still fantastic. And suddenly everybody wants to have all their money in shares. So it's tempering that expectation again.
What about property? Because property stands out on a one-year basis. It has stood out for some time now. 37% return. You look at that 5-year return also, it's still lucrative, 20%. Where do you stand on the listed property space?
Well, it's an interesting asset class. I think to me, fund managers have been structurally underweight property all along. They just, if you look at their portfolios, they've had a very small exposure, massive underweight in listed property. And all of a sudden now we're starting to see more and more interest in the property sector. I see new property ETFs being listed now all of a sudden. And I think that kind of return is a structural correction of our country's past. We had the whole closed economy, where you had every insurance company owning all the property in the country, and major industrial groups. All of that's now changed. So now we've got a more normal property market, and I think the returns we're seeing there are a result of that, and also the massive drop in interest rates. 30-year lows, 35-year lows. It's unlikely that we're going to see those kinds of returns over the next 10 or 15 years. They're going to normalize again. So it's a case again of saying, it is a nice asset class, I like it, it's a productive asset class, second to normal shares over long periods of time in terms of beating inflation, but don't now overexpose yourself after the run has already happened.
Yeah.
We're coming to performance of ETFs and some great returns here, but Warren, you're a big user of the passive strategies. Look at this Satrix Indy, 38% return over 1 year. I think if you look back over 3 years, it's very strong. We've got a whole range of products here over 3 years that have done very well. Again, the Satrix Indy, 26%, as you can see. The problem is, when we come to ETFs, I kind of think about it as using broad equity market ETFs. So you've got the Satrix 40, and then you've got things like the SWIX. You've got the Nedbank equally weighted top 40. What about some of the style funds? Do you take positions? It's becoming an active choice, but do you talk about strategies and diversifying strategies across?
I think because I don't think anybody would have been able to predict what the Indy did. That kind of movement to those shares very specifically would have been nearly impossible to forecast. So having being able to now make another prediction, which is really what all these forecasts are all about, I think is very difficult.
You mean on stocks or sectors? Are getting more specific there?
Sectors, yeah. So if you're going to be in the index, my view is I like the idea of that equally weighted top 40 and SWIX, for example. To me, those are broad market. They're going to give you some kind of reasonable exposure to the market, and that at a very low cost. And that's the big thing about ETFs.
Does that mean you start discouraging investors who want to take a very specific view on certain sectors, resources, for example, at this point in time could be seen as that long-term investment view right now?
Like the Satrix Resi or the eRafi Resi.
Yeah. So that's a great question, because that is a massively undervalued sector. The question then would be, how much of your capital are you going to commit there? So if someone's got a strong conviction that's a good call to make, what I'd do is I'd say great, but then do it with a limited amount of your capital. Don't now go and put 70% of all of your equity investments into that, because that's just too big a bet.
Sam, we've got the next slide. This is the slide that actually shows how many general equity funds, we have the ASISA general equity classification, have beaten the all share index, and you can use, I guess, the Satrix 40 as a proxy there, because the all share and the top 40 index perform almost in tandem directly. Over 1 year, just over 15%. 3 years, we're getting up to, about 25%, and then 5 years, 43%. Why does this graph not make sense?
Because it doesn't reflect history, it doesn't reflect the reality. If you go back and you say how many of those unit trusts were around, that 5-year number, let's say there's only 40 or 50, I don't know the exact number, but if you actually went back 5 years ago and said, well, how many of them were around at that time, there would be double that number. Mm-hmm. And that's really the problem here is, it's something that we spoke about, that the survivorship bias, and that's the problem, is poorly performing funds are just simply closed. And so their numbers disappear out of the track record, which makes that very misleading.
But what it does point out is, if you're just looking at, I suppose, the 1 year basis, how few funds in South Africa outperform indices, passive investment options.
Exactly. And if you actually incorporate the funds that have been closed into those numbers, it's somewhere around 1 or 2 out of every 10 active funds actually beat the market over long periods of time.
Very hard stat, but to come back and to push you here, we've got some of the top 5 equity funds over a period of 5 years, and there is a great degree of alpha. I mean, we look at some of these funds. We've got here the Coronation Equity Fund, and I'm sure our viewers are probably struggling to see this. We've got the Marriott Dividend Growth Fund, which over 5 years returned 23.68 off an initial investment of 10,000. This doesn't sell you on using active funds, even the degree that some of these funds outperform.
I think that's the point, is that when an active fund gets it right, it does do it substantially. The problem is, how are you going to be that accurate to choose those specific funds going forward?
Were these the superstars 5 years ago?
Not necessarily. I mean, for example, the Rainmaker Fund is one that has been a superstar over many, many years. It's not here, and it was one that got massive inflows. Mm-hmm. So, the one that gets marketed a lot, Alan Gray's not here. So it's interesting is that those numbers do change as well. And I'm not arguing the point that there are a few that do, but how do you pick them with such a high degree of conviction going forward?
So what are some of the key criteria? You're looking at a fund, and of course, some of the issues that you look at, some of the key criteria you look at to evaluate any fund if you're looking to put a portion of your clients' investments in unit trusts.
It's number one is cost. How expensive are they? Do they have performance fees? If they've got performance fees, I'm not interested. Mm-hmm. As simple as that, because I think it prejudices the investor. And then I think their process and how strong is the team, what's their long-term track record as a team. Those are important criteria for me.
We've got the recent introduction of the RMB Midcap ETF is going to give these funds a big run for their money. These are the small midcap funds. Obviously an area that's many times, if you're using an ETF or you're using a big fund manager, are underrepresented in an investor's portfolio. Is there a case to use either a passive strategy in this space or some of the great funds? And I think out of the 5 funds we surveyed here, I think the Nedgroup Investment Entrepreneur Fund, which is run by ABAX Investments, was the best performer over this time period. Where does this fit into the investor portfolio?
I think there is a natural small cap phenomenon where small caps do beat the market over long periods of time. So that would be one that I would be in, and I wouldn't mind the ETF basis there. I think our market is so small in terms of the number of shares that paying a manager to avoid the obvious mistakes might be valuable in this instance, but I wouldn't mind the ETF either.
So you like both?
I like both, yeah.
Very interesting here just to see. We had the index here, which is in this funny turquoise color. Most of these funds very underperformed the market in the downturn. So is timing the market right for these types of funds? Because now we're starting to see a little bit more interest in small and mid-cap shares. They've been forgotten for the best part of 4 years.
Yeah.
But now a lot of fund managers are saying, well, there's value there now. We need to go further down the feeding chain on the all share and look at some of these companies because there is promise there. Do you try and time that?
I mean, I think it's one of those things where I wouldn't be too focused on the timing issue. I think investing in shares is a 10-year game at least, but there is a natural phenomenon when the market's fallen. The initial recovery always goes to the big companies first, and then towards the end of a recovery is when you see the small companies.
And is it
really
always harder
benefiting.
for the smaller caps?
It is in the beginning,
Generally.
and then later it becomes easy.
Yeah.
We've
The
got
last thing, balance funds over 5 years.
That's it. This is a fund, I guess, a fund category that has seen massive inflows, and there's a few things happening in this space. We've seen more regulation around financial advisors, and the decision around asset allocation has effectively been removed. There's been an incentive to remove that from the decision of the financial advisors and put that in the hands of the investment managers. I wanted to know, A, what you thought about that, and B, balanced funds, are they, is there a case to be made to use that in the ETF space as well?
I think it's the fundamental decision that an investment advisor makes, and the fundamental value that the investment advisor adds to their client is the asset allocation decision. And by the fund manager outsourcing that responsibility, they've effectively abdicated responsibility. So I think that's a cop-out, and I wouldn't pay my fund manager to make that decision.
Having financial advisor.
The financial advisor.
Okay.
I think so if you've got an advisor, the advisor tells you what exposure to have to cash, bonds, property and shares, gets you in the right allocation, and make sure you stick to that. That's the job of the advisor.
Don't go and buy a balanced portfolio and then you have to incorporate that as well into the percentages.
Yeah, what I love here is that you get the advisor who goes and chooses 4 balanced funds and says to the client, look, these are now, you choose these and this will be great, and they'll do all of this market timing stuff for you. I think that's a cop out, and I don't think they add any value.